The best performing country on the screen, if you haven't seen it yet, Korea was almost up 100% last year. Reminder, this is not a commercial to liquidate your US investments and go flying overseas with all your investable dollars in your portfolio. It's just a reminder, we have a pie, we have a slice. It belongs both developed international and emerging markets. And last year was a perfect opportunity to see why. So the US markets were very healthy last year, up over 17. International developed, you'll see up over 31. Emerging did even better. Global real estate was half of the US market. And the bond market, both in the US and global, lagged equity markets. But the US bond market was a very healthy 7.3% return. The takeaway here is this. If you liquidated out of fear in 2008 in the US markets, you missed 9 straight positive years. That's why we don't panic out. And that's why we stay the course. And it's time in the market, not timing the market. We forget on one day, April 4th, the market was down 6% on the day. But less than a week later, what happened? 9.5% increase in one day, April 9th. Why did that happen? He postponed it for 90 days, these tariffs. So again, you could have been panicked out at a 6% decline. Less than a week later, the market had recovered from that sort of thing. The declines are temporary. The advance is permanent. It took 54 trading days to recover from his tariff announcement. That was it.
What experts usually say is it's a harbinger of doom when you see an inverted yield curve, because it means that there's a premium on cash right now. No one's willing to lend money out in the future. It's really supposed to be a super bad thing. And certainly when the yield curve inverted back in 2022, when the Fed raised the interest rates, people were really concerned that it was going to be a big economic disaster. It has not been the case so far. I mean, tomorrow's a new day. But certainly what we're seeing now is way closer to normal. And what that means is that interest rates as a whole are falling. And that's sort of what we'd expect. We can expect lower returns in general for our fixed income, but the yields and the interest that you'll be getting next year will likely be lower than what you saw in 2024. The yield curve's going down, which is a good thing, and they're normalizing, which is a good thing. Normal's always good.
What I get people say a lot of times is, well, listen, the price of eggs hasn't come down. It's still inflation. It's still going up. It's just going up at a slower rate than it had been. But what I like to focus on is what midterms typically do, the stock market in midterm elections. I think it's important because it goes back to what Scott was saying, which is every year there's volatility. So in midterm years, there's typically a little more volatility. Standard deviation is about 16% in midterm years, while it's about 13% in other years. What does that mean? That means that we can't get too excited. There is going to be most likely volatility this year. And what we know is that the market goes up. A lot of AI companies, as we know, are private companies. We can't even invest in them. Our asset price is expanding, sure, but we also don't know if the capital expenditure is going to get sort of soaked up by the AI usage. We know that AI is real. We know that it's growing rapidly. The use is growing rapidly. We also know that companies are spending rapidly.